watching Daybreak Asia, coming to you live from New York, Sydney and Hong Kong.
We're counting down to the opens in Tokyo and Seoul.
Australia has just come online. The top stories this hour. The US securities regulator says its X account was compromised after a fake post saying approval had been granted for spot Bitcoin ETFs. Caution returning to markets ahead of Thursday's US inflation data. Treasury yields are remaining above 4%. Plus, BlackRock cutting hundreds of jobs, blaming what it calls unprecedented challenges in asset management. We do have some jobs numbers coming out of South Korea. This is the December reading for the unemployment rate, rising to 3.3%. The estimate was for 2.9%, and certainly a significant acceleration from that 2.8% in the November reading. When it comes to the number of jobs added in December, 285,000 jobs from a year earlier. Labour force participation rate at 63.8% in December. The population over the age of 15 years increased about 0.4% from a year ago. So certainly that calls into question potentially whether we see that changing the mood music when it comes to the Bank of Korea, right? Expectations had been, given how resilient still ultimately the job market had been, that the Bank of Korea would really stay at that record high level for longer. Does this now kind of cast into question what we could see in terms of the higher for longer narrative there? We did see economists from Bloomberg expecting a climb to 3%, but 3.3% actually exceeding those expectations. That record low, remember, was 2.4% in August. We are still at fairly low levels compared with that post-pandemic average, but at 3.3%, we've gone back about to that post-pandemic average level. So this will be quite interesting in terms of how much room the Bank of Korea now has to keep rates tighter for longer.
Yeah, that's right. Something the BOK is going to be tracking very closely, just continuing to monitor any signals of weakness coming through in the labour market, but one certainly just there. But here's the open we've got for Australia in the session today, and you can see a little bit of weakness creeping through, pretty range-bound as well, and it sort of follows the direction we had on Wall Street trading, given it was pretty subdued, as I said, trading throughout the course of the session. So traders are really just waiting for any sort of direction, and the inflation print, of course, is going to be the next big one to watch. Yields, again, seeing fairly steady. We did see treasuries holding above the 4% mark, and the dollar, Aussie dollar that is, unchanged against the greenback at this point in time. But let's change on, because there is one data point to note in Australia. So we've got the monthly inflation print that's coming up in the next hour here. You can see the previous reading from October. That was at 4.9%. Economists, they are expecting that to tick down to 4.4% in the November reading, but still saying yes, it's something the RBA is going to be tracking closely. They're likely, though, to see once we get those quarterly figures, once we get the December reading as well. That's due just before the RBA next meets in early February, but could still continue that trend. Price pressures are coming down lower, so the RBA, even though likely to keep rates higher for longer, still something, again, they're going to be tracking closely. So inflation in Australia, of course, it's that big countdown, though, Vonnie, to the CPI print from the US.
Exactly, Belle, and we had a big rally in the Monday session, a very choppy trading session in the Tuesday session, so we'll have to see how things shape up for Wednesday. Right now it looks like we might be to the downside, but it is very early going and there's lots to digest for this market. For example, we just got word that Intel and is coming out with an announcement, but we also got confirmation of the Juniper Networks deal, that it's going to be acquired by Hewlett-Packard Enterprises, and the moves that those companies had made in the regular session are being exacerbated now in the post-market. So Hewlett-Packard Enterprises is down post-market, Juniper up post-market, having already made moves in the regular session. Then if you look at bonds, we had Bill Gross saying today that at 4% the 10-year is a little rich, so it looks like we're going to see a little bit more reaction in the Wednesday session to those comments. The 10-year at around 4.01 in the Tuesday session. And then crude oil, it doesn't look like all that much is happening right now, but we have commentators saying that the physical fundamentals look a little bit more supported at this level, $72. It's been in a range of about $5 since December. The real action, though, the dynamite, came after the closing bell today, Heidi, in Bitcoin.
What a whiplash kind of a couple of hours it's been, right? SEC Chair Gary Gensler saying the regulator has not, in fact, approved Bitcoin ETFs and that the agency's X account was, quote, compromised, resulting in an unauthorized post appearing to confirm the news. Let's take a look at what's been going on. Let's bring in Bloomberg Intelligence senior ETF analyst Eric Bochunas. There'll be a lot of soul searching happening at the SEC in terms of how this happened, why this happened, and you know, ultimately, I guess the market kind of moved on the rumor and sold on the fact. But what do you make of all of this?
I mean, I'm not a crypto person. I'm an ETF person, but I've been put into the crypto world for about 6 months in an intense way. And this is kind of par for the course, although this is the SEC, so it's almost like a bigger deal, obviously. But there was a couple false positives and fake news events that have happened over the sort of process of the since BlackRock filed their ETF application and today. So I'm used to the twists and turns, to be honest. That said, I think it was hacked. But what's weird about the hack is this. We're expecting tomorrow at this exact time when the tweet went out, exactly 24 hours, for the approval to happen. We heard it was going to happen between 4 and 5 p.m. on Eastern time on Wednesday. This tweet went out exactly 24 hours. It almost felt like a scheduled tweet with the wrong day, to be honest. But they're saying it's hacked. Let's assume it. They aren't saying it's wrong, though. That's notable. They're just saying it was compromised. They're not saying this is not true, we're going to deny them. It says they haven't approved them. We think they're going to approve them tomorrow, and the big reason why, they have to make a decision. ARC's final deadline is tomorrow. This is like legally binding, so they either have to approve them or deny them. If they do nothing, ARC is automatically approved. So we're expecting this to be just another weird blip in this long and crazy road onto approval. And at 4 or 5 p.m., I think we'll see this happen for real. And then we'll see these ETFs launch come Thursday morning Eastern time.
Eric, we're seeing price action in the aftermarket now take an actual direction. It looks like people just ran back to their computers, and that in the initial stages after this, you know, there was, as you said, a whiplash response. But now we're very much seeing Bitcoin add. So we're back up above $46,000. I'm just taking a look at BITO. Well, it's not really trading, as far as I can tell, too much in the after hours. But, you know, there are other ripple effects from this as well. Can we take from this that Bitcoin will go higher if there is an approval?
Yeah, this is tough to say. At BI, we can't make price predictions anyway. But even if I could, I would tell you I don't know. The short-term price trading of Bitcoin is hard to predict. I will say two things, though. One, people need to know that when the Bitcoin futures ETF was filed, the Bitcoin rallied up until it launched. And then when BITO launched, there was a sell-off. In fact, that's still the high watermark of Bitcoin's price, was right when BITO launched. So there is that. There was a sell the news event then. Do with that with what you will. The other thing I will say, though, is medium and long term, these ETFs are going to act like bridges to the advisor world and the institutional world. The advisors in particular, they trust ETFs. They are their preferred format for putting into client portfolios. So just the fact that these ETFs exist, there'll be some traffic on that bridge. And BlackRock and Fidelity involved really legitimize this. So we do think the advisor market, which is $30 trillion, they'll nibble at this for sure over the next 3 or 4 years. So we're thinking 50 to 100 billion in assets, let's say 3 to 4 years from now. And then 5 years, I see it as equivalent to gold ETFs, which have about 100 billion. But remember, that 100 billion is still only 1% of all ETF assets. So it's small relative to the big pie of money and funds, but it is big relative to Bitcoin's market cap.
Bloomberg Intelligence ETF analyst Eric Bochunas, thank you so much for joining. I want to point out that we are getting from the SEC now word that the false post on the Bitcoin ETF was not sent by its staff. I want to reiterate, the SEC is saying that the false post on the Bitcoin ETF that was released after market closed was not sent by the SEC's staff. Of course, just to reiterate, we have Bitcoin up about 1.5% versus the US dollar now, trading above $46,100 a coin. We do not have approval yet from the SEC on any Bitcoin ETFs that are in the works. Let's turn now to the broader markets. Catherine Kaminsky is Chief Research Strategist and Portfolio Manager at Alpha Simplex Group, and she joins us now. Katie, great to have you on. I want to just start somewhere else for a moment. The Federal Reserve and Lael Brainerd talking about prices not quite coming down, that companies are not reducing their prices perhaps in line with how inflation is ebbing. Do you see this as being a challenge for the Federal Reserve in the months to come?
Yes, if that's the case, you would expect that inflation is going to be somewhat more sticky. So it means that we may take longer to see cuts. And if you look at where the market is right now, the market is really pricing in cuts coming sooner rather than later. And so I think that's where we're going to have a little bit of a disconnect. So I'd have to agree.
Now, if that's the case, when do you anticipate that we will start seeing cuts? Markets are still not fully on board, to say the very least, with the Federal Reserve and its potential 3 cuts this year.
Well, I think the challenge with that question is that we have to see more data on the inflation front. And I do really think, and we all, if we look where we are now, we haven't gotten to target on inflation. And if you look at signals in general, they've been relatively positive, but there's still a lot of uncertainty. I think the biggest technical signals that concern me are the fact that stock bond correlation continues to be positive, that bond volatility continues to be very high and elevated. And I think you were just mentioning this about sort of bonds having equity-like returns. So until we figure out where bonds have to be, I just really think nobody really knows how we're going to navigate this yet. So our view is that there's a lot of different outcomes that we have to think about this year. We're actually thinking that a soft landing is a little optimistic, that instead it's probably going to be much more of a range, a little bit more of a pendulum going back and forth between different views on how we get there.
A little bit of a bumpy ride, as you put it. Well, one thing that you can say with a little bit of conviction, at least, is that after 9 straight quarters, fixed income signals are finally net long. You're looking for a steepening yield curve. So what do we do with that?
So this is a really important point in that trend signals, and particularly technical signals, had been short fixed income for 9 quarters. This has been one of the biggest bear trends in fixed income in decades. And what's interesting about that is that has shifted course, and many of the signals have moved directions and asset classes. So we're definitely moving to a new normal, to a new trend environment where market trends look more like a soft landing right now. And when you think about the fixed income trend, the next thing to think about is a steepener. So where you're going to think about that as being long the short end and perhaps short the long end of the curve, expecting that you're going to have a steeper yield curve at some point, a normalization of yields that we've been looking for quite some time now.
What about stocks, Katie? I mean, if you're not certain, about what's going to happen over the year, but if you know that there are some signals telling us certain things, are there areas of the stock market where you can be a little bit more convinced that, we'll see better returns?
Well, this is a good question because we have seen much more resilience in the U.S. markets versus Asia, particularly China. That trend has worked relatively well. But when you think about how to focus on the equity markets this year, it's going to be a little tricky because it's going to really depend on what happens with rates. And that's why I said until rates can calm down, until we figure out, it's probably better to be a little bit conservative and also think about which areas of, in terms of geographically or sectors, which might profit from this type of scenario.
Interestingly, you are very convinced that long Japan, short China will be a good trade for the year. Just give us a little bit more context there. Perhaps the short China portion might be a little bit easier to understand than the long Japan, given that we've already seen quite the run-up in Japan.
That's a good point. I mean, I think the challenge is that signal has worked relatively well. I know that the Nikkei has hit almost a 34-year high. So we're definitely moving into new high territory. But I think until we actually see a policy change in Japan, we're still going to see potential possible upside in Japan. And this has been the case with the yen. People have been second guessing that yen train for 2 to 3 years, and it still has had some legs. So I think we have to actually see some confirmation that trend is over before that we can actually give up on some of that conviction.
Katie, thank you so much for your time today. That is Catherine Kaminsky. She's Chief Research Strategist and Portfolio Manager at Alpha Simplex Group. Still ahead, Taiwan's opposition, KMT, seeking to capitalise on a false missile alert that's raised anxiety levels just days ahead of the presidential election. We report from a rally for their candidate later this hour. But first, Boeing CEO reportedly says the firm needs to acknowledge its mistakes after a mid-air fuselage blowout. An update from their all-hands meeting next. This is Bloomberg.
Well, the Wall Street Journal was reporting that Boeing CEO Dave Calhoun has told employees a company needs to acknowledge its mistake. Calhoun called for an all-hands meeting on Tuesday with a focus on safety. Bloomberg's Katrina Nicholas joins us now. So, Katrina, what do we know about this meeting? Because we also know that for Boeing and the leadership, it's a key transition year.
Exactly. I mean, and something of a mea culpa moment, really, for Boeing this morning. They held this all-hands meeting, as you said, at one of their 737 MAX factories just outside of Seattle. It was webcast across the globe to all of the Boeing employees worldwide. And Dave Calhoun really promising transparency, pledging to acknowledge the mistakes. He was up there with Boeing's chief planes CEO, Stan Deal, and also Mike Delaney, who's in charge of safety, and employees who were listening into this, you know, telling us that they were encouraged to speak out. You know, if they see problems, to, you know, don't be silent about those sort of things, to speak out, and the engineers really encouraged to, you know, if there is a problem, speak out about it. So, you know, and this really is a bittersweet moment for Boeing, really, because of course the other news that we had was their December delivery orders, and it was a record. It was a record month for them. They had, you know, about 301 deliveries placed for their MAX, the best-selling planes, and about 301 deliveries in December in total, and that sort of brought it up to an annual total of about 1,300 jets. So this is something really that Boeing should have been celebrating, but instead it's been clouded by this Alaska Air event over the weekend.
Yeah, I mean, loose bolts. Come on, Katrina. You know, it beggars belief. And the NTSB has flagged that it might even look to widen its investigation now. What's the latest on that front?
Yes, so that's what the NTSB did say last night when they fronted the media again in another press conference. The focus seems to be around these 4 missing bolts. So these were bolts that would have held that door plug in place, and, you know, they haven't been found. And the NTSB investigators were saying yesterday, you know, the question is, you know, were they there indeed in the first place? Who knows? But what happened was this door sort of moved up vertically, and because those bolts, you know, perhaps were loose or maybe were not there, this door moved up past these 12 fasteners that were meant to hold it in its place, and then ejected outwards, of course, causing the cabin depressurization that we saw and sparking that what could have been a very serious incident. So, you know, this is something that I think investigators will focus on. That news also came after United Airlines and Alaska Air also said that they were finding more loose bolts, and even we had the regulator in India saying that one of the MAX jets that they had examined had a washer that was missing. So lots of concerning news coming out around that sort of engineering front.
Yeah, you would like to think your airplane was fully assembled before boarding. That's Bloomberg's Katrina Nicholas. Thank you so much for joining us. Meanwhile, BlackRock, the world's biggest asset manager, is slashing 3% of its global workforce. That's about 600 employees. Bloomberg's Sue Keenan joins us now. And Sue, CEO Larry Fink is citing a dramatic shift in the industry as a reason.
Yeah, the CEO and the president informing staff that they're seeing the most profound changes since they founded BlackRock, which, again, is a major asset manager. And this is the latest of a series of staff staff cuts. They're announcing a 3% or roughly 600 worker reduction. You might recall they announced such cuts of about 500 workers a year ago in January and then cut again a smaller amount in June. BlackRock is among several big money managers, including Wellington Management, T. Rowe Price, and others that have recently cut jobs and redirected budgets in response. Now, this is the key part, because what BlackRock is saying is that they expect to have more staff by the end of the year, and what they're actually doing here is cutting the budget and redirecting. They're saying that the ETFs have become the preferred vehicle for both index and active investment strategy, and that the firm is growing across the globe, including in Europe and Asia. CEO Larry Fink and President Rob Kapito, in their memo, notably said that of all the changes they're seeing, perhaps most profound are the, quote, new technologies poised to transform the industry and every other industry. You have to believe they're referring to AI, among other things here. BlackRock is aiming to expand into the growing market for alternative investment with the goal of doubling revenue from private markets over the next 5 years. They've stated that the firm has more than $9 trillion in assets as of September, and we're starting to see a lot of these financial firms report earnings. They report fourth quarter earnings on Friday.
Jane Street is reporting more than $7 billion in net trading revenue for the first 9 months of last year.
Yeah, this is coming to us through a Bloomberg source who's had access to some of the data. And this is really interesting because it just shows you that firms such as Jane Street that have a proprietary trading mechanism have really been exposed to a trading windfall. The $7.3 billion in net trading revenue, again, for the first 3 quarters of the year, follows on the heels of 2022's $10.7 billion in revenue. These figures, again, were disclosed to investors who were privy to some debt deal information, and they say, the sources, that the company is expecting to generate $3 to $3.5 billion of net trading in the fourth quarter. So that would put them at or exceeding what they made in 2022. Again, it's noteworthy because with the mix of the recession, the rate hikes, the wars, and geopolitical currents we've seen, there's been huge gyrations in trading, and firms like Jane Street that use technologies and algorithms to capture the profit and profit from the differential in different asset classes have really done well. It's also noteworthy because Jane Street is one of those companies that can actually create ETFs, and this has emerged during all the focus on the spot Bitcoin ETF applicants, that they are the preferred broker of choice to be involved by all those potential issuers. Back to you.
Bloomberg's Sue Keenan there. Thank you very much, Sue. And you can get a roundup of the stories you need to know to get your day going in today's edition of Daybreak. Terminal subscribers go to DayBgo. It's also available on mobile in the Bloomberg Anywhere app. And you can also customize your settings so you only get news on the industries and assets you care about. This is Bloomberg.
You're watching Daybreak Asia, the latest corporate stories that we're following this hour. And Amazon's live streaming site Twitch is said to be poised to cut 35% of its staff. That's about 500 workers. Sources say the cuts come amid concerns over losses at Twitch, and several top executives have left in the span of a few months. We're told the business remains unprofitable 9 years after Amazon's acquisition. Hewlett-Packard Enterprise has agreed to buy Juniper Networks for $14 billion. The move will expand its presence in networking, but is meeting skepticism from analysts and investors alike. HPE will pay $40 a share in cash, equating to more than half of its $21 billion market value and a 32% premium over Juniper's closing price before deal talks emerged. Coming up next, Blinken makes another stop to Israel. We get the latest. This is Bloomberg.
Breaking news now, we have Japan labour cash earnings for November coming in weaker than anticipated. Japanese salaries in November rising 0.2% from a year earlier, according to the Ministry of Health, Labour and Welfare in Tokyo. So that's up 2%. The estimate was for them to be up 1.5%, absolutely not keeping up with inflation in Japan. Now, we were anticipating that it would be less than October's increase because in October there were different base effects and and it was mostly a bonus issue as opposed to a base salary. But this is much weaker than anticipated. Adjusted for inflation, real wages actually fell 3% year over year versus a drop of 2.3% in the previous month. So let's see how the yen is taking all of that. The yen was trading a little weaker today. Right now, we're trading at 144.42, so not a huge amount of reaction. Futures were higher and they continue to be higher after we learned that wages came in weaker than anticipated growth-wise in November, rising 0.2% from a year earlier. So Bell's having a look at the broader markets now as they open across Asia. Annabelle.
Yeah, Vonnie, just also tracking the reaction that we've got in Japan stocks as well, given we've got the futures that are just opening that contract there in Singapore, and we're pointing to some gains here. It is partly coming down to a BOJ story because one of the reasons we've seen such a big run-up in Japanese stocks over the course of last year was that the BOJ was sticking with its easy policy settings, and that latest data you just mentioned there, just another data point perhaps that they're going to be looking to justify those decisions. But the yen, a little changed. Equities generally in the region fairly subdued, a little bit of weakness coming through, but that was also the story on Wall Street where stocks are really struggling for direction and looking ahead to the US inflation print coming Thursday. What else we've been noting, though, on the data front is some unemployment data that we had in Korea at the top of the hour. So let's take a look at that because it does really play into these expectations around what the BOK is going to be doing. The Bank of Korea is the first Asian central bank to meet on Thursday. The expectation is that we're going to see a hold, but still, when you take a look at some of the economic data that's come through, so that adjusted jobless rate, for instance, rising to 3.3%, really undershooting what economists had been expecting. It points to that tail you're also seeing in the bond market as well, because the yield is at an 11-month low. That pressure is really building on the Bank of Korea now to ease to some degree. So two cuts are expected over the course of this year. There has been resilience in the economy, but still consumption is expected to wane over the course of 2024. And I think that unemployment number really plays into that narrative as well, Vonnie.
Thanks, Annabelle. We will be back with you very, very shortly. Meanwhile, the president of Eurasia Group says Washington is incapable of containing geopolitical risks and sees the United States itself as the top risk for 2024. Ian Bremmer told us the country's democratic institutions have suffered decades of decline and now face fresh threats.
When you have the former Secretary of Defense under Trump saying this man is a threat to democracy, he was in charge of American national security under Trump. When you have the person who is running having tried to subvert a free and fair transfer of power, doing everything in his power to do so, in a functional democracy, that would be the #1 issue of the election. Nothing else would be close. So is it that we're somehow getting our facts wrong? Or is it that the United States is not a consolidated functional democracy? Because there ain't no other advanced industrial democracies. No one else in the G7 is having the problems in legitimacy of its political institutions that the United States is experiencing in 2024.
What do you think it is?
What do I think?
What do you think it is? Do you think it is a functioning democracy?
No, I think it's a hybrid system. I think the U.S. democratic institutions have significantly eroded over the course of the past several decades. We have normalized that because all of the things that are unprecedented as they happen, and we still live here in the United States, we're basically saying, well, okay, I guess that's the way it works now. So impeachment doesn't work and we can impeach someone twice and they can still run again. I guess that's the way it works. You can have 91 indictments, and I guess that's the way it works. You can post and say things that you never would have heard. I guess that's the way it works. Now, as set against the context of the world's most powerful, very functional economy and the world's most functional, very powerful global defense capacity, you'd say, well, maybe it's okay that the United States isn't a functional democracy, but it will be different. And so, yeah, I think we can't normalize the dysfunction of the U.S. political system, the illegitimacy of its institutions, and the fact that democracy in 2024 in the United States is in crisis. That is the reality. And our allies know that. They're deeply worried about it, all of them around the world. And our adversaries see this as potentially a huge opportunity for themselves.
So where do you see us 12 months from now? What do things look like?
First of all, let's talk about March, April, May. Tom said you need to completely rewrite this then. When Trump gets the nomination, which is very, very likely, he will overnight become far more powerful on the U.S. and the global stage. All of the Republicans will be loyal to him in a way that right now they still have hedging capacity. And the media that is following and supporting Trump, and the ability to raise money to drive that campaign. And that means his policy pronouncements, like there would never be a war against Israel if I was president because I showed the Iranians, I announced that assassination of Qasem Soleimani. Well, that's going to be the policy for Trump and therefore the Republicans. Zelensky, corrupt. I'd end this war in a day. I'd show him what's what. I'm not going to give him billions and billions of dollars on the back of the American taxpayers. That becomes the policy. So the Overton window, right, of what is an acceptable policy frame debate in the United States is going to change very dramatically when Trump becomes the nominee. Again, assuming that. It's not given, but assuming that. And in 12 months' time, the stakes are a lot higher for both leaders than they ever have been before, right? So if Trump wins, Biden and many, many people around him believe that they will face legal jeopardy, that Trump will politicize the FBI, the DOJ, the IRS, and go after them in a McCarthyite, prioritization of policy, where Trump, of course, faces potential prison time. So the stakes are much, much higher than we saw in 2020.
Eurasia Group President Ian Bremmer there speaking with our colleague Jonathan Ferro. Well, U.S. Secretary of State Antony Blinken says Israel must stop undercutting Palestinian governance and rein in settler violence. It's some of the most direct criticism of Prime Minister Benjamin Netanyahu's government since the start of the Hamas war. Israel has largely ignored growing calls to scale back the intensity of its campaign in Gaza and is pushing ahead with its plan to target Hamas leaders.
We continue to stand with Israel in ensuring that October 7th can never happen again. We believe the submission against Israel to the International Court of Justice distracts the world from all of these important efforts. And moreover, the charge of genocide is meritless.
Let's bring in Aaron David Miller, who's a senior fellow at the Carnegie Endowment for International Peace. He was previously a State Department negotiator on Middle East issues. Aaron, really great to have you with us. How deep is the disconnect now between Israel and the US? Because we see Secretary Blinken and President Biden continuously pressing for Israel to fundamentally change its military tactics, right? On the other hand, we see the operations pushing ahead almost as intensive as ever at the time when we see a humanitarian crisis just worsening. Is there any room for compromise?
Well, I think absolutely there's room for compromise, in large part because the Biden administration does not want, and I suspect will not allow, an open breach in which you have a sustained public fight and fundamental discord, both on strategy and tactics. The administration has an expectation by the end of January that the character of the Israeli ground campaign in the south and central Gaza is going to change. Going to change from division-size operations with an emphasis on artillery and airstrikes, heavy, comprehensive artillery and airstrikes, to brigade-size, more intelligence-driven operations, which should minimize the exponential rise in Palestinian deaths and allow for much more humanitarian assistance, not to dribble into Gaza, but to surge into Gaza. In northern Gaza, the Israelis have their forces, and I think are willing, under some pressure by the United States, to allow Palestinians to return. So I think there's a real intent, at least in Washington, to avoid such a breach.
There's pressure on both sides. Of course, it's an election year for the US and for Israel, for Netanyahu. You've talked about this potential for a political reckoning. He needs this victory, right? When does the clock count down?
Well, for Benjamin Netanyahu, there will be a reckoning. The problem is there's no mechanism to remove him. Israel is in the middle of a campaign, a war. He has two governments, basically, a war cabinet, which increases his parliamentary majority. Benny Gantz, former Minister of Defense, has been brought in. And he has his other government, which is the most extreme right-wing government in the history of the State of Israel, with two ministers who are pursuing policies on the West Bank and which are annexationist in everything but name, and actually declaring that they want to remove Palestinians from Gaza. There's no mechanism right now to get rid of this Israeli prime minister. His coalition will not self-destruct. It may well be that he will be prime minister of the state of Israel this time in a year or so. There will be a state commission of inquiry. It'll file a report. If the past is any precedent, I think public pressure will mount. And at some point, there'll either be the reconstitution of the government or new elections. But right now, and for the foreseeable future, let's call 2024 the year of Gaza, I think you're going to be dealing with this Israeli prime minister.
Aaron, you talk about the public dimension of this war and public pressure, right? We know that there are, it's been played out across social media. There's a huge amount of criticism and distress, not to mention cases and investigations at both the International Criminal Court and the International Court of Justice. Do all of these things matter in terms of actually meaningfully creating a change in the way that this narrative is being written?
I think they matter. The question is, will they fundamentally succeed in altering the course that the Israelis are on? And I think the answer to that is no. And there's only one power center that has perhaps the capacity to do that, and that's the Biden administration. And frankly, even though there's been enormous criticism of the administration's efforts on 3 issues, it really has done something to press Israel. There wouldn't be a scintilla of economic or humanitarian aid into Gaza without pressure from the United States, number one. Number two, I doubt, frankly, whether there would have been any hostage negotiations without the personal intervention of the president. And number three, I think the Israelis by now might have actually preempted on the Israeli-Lebanese border against Hezbollah. And we could have easily been, which we are not now, although I still wouldn't rule it out, a serious and dramatic regional escalation. The problem is you have an Israeli government which cannot engage in what I would call sober and realistic planning for the day after. Because the minute Mr. Netanyahu does that, agrees to the return of the Palestinian Authority, agrees to the extent that his objectives against Hamas, their total destruction may not be possible, and refuses to accept any sort of political horizon, like a two-state solution, however problematic it is and how distant any negotiations on that basis may be, his coalition is going to collapse. That's the real issue. This Israeli prime minister has conflated his own political and legal travails with the war effort. And that is not a good place, frankly, to create sound decision-makings about the future, or frankly, not a terribly stable basis for the U.S.-Israeli relationship either.
Secretary Blinken said this week that Saudi Arabia and other nations remain still interested in potentially building, normalizing relations with Israel after all this, but that really depends on the path to the Palestinian governance afterwards. Do you think that's an enticing enough carrot for Israel?
It's interesting. I mean, it is intriguing that the Abraham Accord countries, the UAE, the Bahrainis, have not broken relations with Israel, despite the fact that you've got almost 23,000 Palestinians killed and a degree of destruction that is unprecedented in the history of Israeli-Palestinian conflicts between Hamas and Israel in Gaza, and yet no fracture in relations. I think, frankly, Mohammed bin Salman, aka MBS, will still be very interested in some degree of normalization because of what the U.S. is offering him. And what the U.S. is offering him is, number one, a mutual defense treaty. I asked myself the question the other day, when was the last time the United States concluded any mutual defense agreement treaty which obligated the United States to come to the defense of another country? It was the revision of the U.S.-Japan Treaty in 1960. And MBS, Mohammed bin Salman, wants help with a nuclear reactor and other bells and whistles in terms of military assistance. So if he gets that from the Biden administration or a successor, would he be willing to settle for a sort of Palestinian state light sort of approach? I think the answer is Probably, yes, he would be.
Aaron, there's so much to talk about, but before we let you go, I did want to get your views on, of course, New Year, but same issues when it comes to Ukraine. Is a strategy towards Russia of containment still kind of one that, is the right path to take? And I guess also with the US indirectly engaged in 2 wars, how stretched is that bandwidth when it comes to potentially having to deal with something involving China and Taiwan?
I think we're going to have to make a virtue out of necessity, because the battlefield dynamic is not going to produce a significant Ukrainian advance, which will somehow force Vladimir Putin to the negotiating table. So the alternative, frankly, is the long war. And the long war compels a containment strategy. And that containment strategy, sad as it may be, I worry about it, having worked for Republicans and Democrats and voted for Republicans and Democrats, although these Republicans are not my Republicans. That depends on American politics. And it very much will turn the national interest of the United States on this issue, which is critically important to our defense and our security, is going to turn on this coming November's 2024 presidential election. And that is an extremely worrisome state of affairs, when the national interest, frankly, cannot transcend narrow political interests. And that, I'm afraid, is sadly is where we are right now.
Aaron David Miller, really great to have you with us, and we appreciate your time and your insights, Senior Fellow at the Carnegie Endowment. Coming up next, Taiwan's opposition KMT tries to rally support. It's seeking to unseat a government that it says is putting the island at risk. We'll get an update from one of their rallies just ahead. This is Bloomberg.
Watching Daybreak Asia. China's top envoy to the U.S. says Beijing has no room to compromise with those advocating for Taiwan's independence. Ambassador Xie Feng also urged the U.S. to follow the One China principle. Taiwan votes for its next president this Saturday. China has previously called Taiwan's ruling party candidate Lai Ching-te a troublemaker whose views risk sparking a conflict. Relations with China are top of mind for voters ahead of Saturday's poll. Bloomberg's Stephen Engel reports from a rally for one of the opposition candidates from the traditionally Beijing-friendly KMT party.
It was a homecoming crush for opposition KMT presidential hopeful Hou Yu-ih as he rallied the faithful in his hometown of Jiayi in southern Taiwan. Hou and the other opposition candidate, Ke Wen-je of the Taiwan People's Party, or TPP, are making separate last-minute pushes to defeat the more independence-minded ruling DPP and its candidate, Vice President Lai Ching-te. It's a three-horse race for Saturday's election after the two opposition camps failed to form an alliance, a fraught union that could end up splitting the opposition vote.
I feel like the biggest room for cooperation between KMT and TPP will be the number of seats in the legislature. Our goals are the same, to switch the party in power. The DPP government has not been doing well for the past few years. People are more fearful.
That fear she's referring to was amplified Tuesday afternoon when cell phones island-wide blared emergency alerts, erroneously saying that a Chinese missile had flown over Taiwan, and for citizens to be aware. The KMT was quick to latch on to the mistake.
When I first got the alert, I thought it was an earthquake. It turned out to be just a satellite. But the English in the message said it was a missile, so it made people panic. Even though the DPP came out and apologized, it never should have happened, especially now when the election is so intense. It made people feel threatened by China, as if they want to take over Taiwan. I feel like the DPP manufactured this fear.
These two KMT supporters felt felt the same way and see closer ties with China as a benefit, not a threat.
We need to keep good communication with the Chinese Communist Party so we won't have a war.
The two main opposition candidates agree that the DPP is putting Taiwan at risk and that they must diffuse tension across the Taiwan Strait. Now, on the other hand, they cannot show to the Taiwanese people ahead of this election that they're cozying up to Beijing too closely and that people could perceive that their efforts to get closer to China could put the long, hard-fought democracy and freedom here in Taiwan in jeopardy.
I think being closer with China for trade is not such a bad thing. But freedom of thought is what I want more. So I don't want to be closer with China.
It may be the very issue that decides the vote and sets the broader geopolitical tone in East Asia.
It's very, very important, this election, because it's life or death for the Republic of China. Because China is our roots. China and us are inseparable.
Stephen Engel, Bloomberg News, Jiayi, Taiwan.
And we'll have special coverage from Taiwan all week. This is Bloomberg. You're watching Daybreak Asia, the latest tech stories now out of CES. Honda has appeared to walk back a plan to deploy a self-driving car developed with GM by early 2026. CEO Toshihiro Mibe spoke to us at CES in Las Vegas, saying he now expects driverless vehicles to debut by the end of the decade. Honda announced a joint venture back in October with GM's autonomous vehicle unit, Cruise. But Cruise's license has since been suspended in California, parking its entire fleet.
We're thinking of sometime in the late 2020s for introducing self-driving vehicles into an urban environment. The car we're introducing for 2026 will not have such advanced technology.
And Mobileye has unveiled an operating system called DXP. It says it's designed to help automakers develop customized driving systems. The company says it'll allow car makers share software more easily across models. Market opens in Seoul and Tokyo next. This is Bloomberg. This is Daybreak Asia. We're counting down to Asia's major market opens. And indeed, we had a choppy session on Wall Street. It looks like we're waiting for the next milestone, the next catalyst. It could be a central bank meeting, perhaps the BOJ. But certainly, the water cooler talk is going to be all about this Bitcoin event, I think, Heidi, it's fair to say.
Yeah, we're continuing to monitor what has been just a whiplash kind of few headlines this morning, right? But you're right. In that extent, we are fundamentally going back to watching central banks and inflation, right? U.S. inflation is top of mind, obviously, but other key inputs like wages for Japan, Bill, is going to be really key in terms of what the BOJ does next.
Yeah, absolutely. And a dovish BOJ is one of the reasons we've seen those gains in Japanese stocks over the course of last year. Let's take a look at the market open here, because Japanese equities closed out the session yesterday trading at a 1990 high. A lot of the analysts who've been speaking to us saying that there is room for further gains over the course of this year, and a lot of that coming down to corporate governance reform as well. And really that's still being pushed quite extensively in Japan. So you've got equities here greener as we come online this morning, really looking to be one of the brightest spots in the Asian equity session so far. What's playing into that, as you said as well, is the eco data, because just another one to note coming out in the last hour was wage growth for Japanese workers, and that slowed sharply over the course of November. So certainly a sort of an unwelcome development for the BOJ. They're going to be watching those wage negotiations very closely over the course of the first quarter. But that weaker wage growth has been something they've cited as a reason to keep their easy policy settings in place. So you're still seeing that Japanese yen holding around the 145 mark for yet another session, as we continue to see as well the US 10-year Treasury holding above the 4% mark. Let's change on because we've also got eco data to note in Korea today. We had the adjusted jobless rate rising to 3.3%, far undershooting or changing what economists have been expecting, that coming in at an estimate of 2.9%. So it tells us that we're starting to see some cracks that are forming in the Korean labour market, which has been fairly resilient, but also consumption expected to slow over the course of 2024. And that's a reason why a lot of economists and traders in the market as well are starting to hint or put pressure on the BOK to cut over the coming 12 months. So 2 cuts currently priced in, even though if you take a look at what the BOK is expecting, the first central bank in Asia to meet on Thursday, all of the economists that we surveyed are expecting it to hold rates at 3.5% for yet another meeting. So that's the state of play as we come online here. The Kospi, again, just a little bit higher, but again, a bit of a range-bound session. Let's change on, take a look at the Aussie stocks so far. We're 1 hour into the session. Some weakness really coming through, particularly from the materials index, which is really full of the Aussie miners, the likes of Rio, Fortescue, BHP. That's as we see iron ore here. You can see back down to the 135 mark. Still historically elevated levels, but we have seen weakness creeping in. That demand dynamic very much playing into it. So, Heidi, certainly pretty interesting session so far.
And always interesting is Japan, right? We see the Nikkei hitting the highs since the early 90s. Let's bring our next guest, who still favours the Japanese markets. Tech and industrial are also other favourites. Join us now is Jean-Paul Vonnie, who's the head of BlackRock Investment Institute. He previously served as a deputy governor at the Bank of Canada. Jean, great to have you with us. And I just want to throw up this chart in terms of looking at where the Nikkei 225 is trading. And it already was quite a year for Japanese risk assets, but now we're seeing those stocks rallying to that 34-year high. Is the same premise still valid to you in terms of some of the reasons why Japan bulls last year thought this time it really is different?
Very much so. I think, we've turned positive on Japan during the course of 2023 for the reason that we already discussed. I think the macro, we have a very challenging macro environment, we think, in DM economies, generally speaking, globally, but that doesn't apply to Japan. The inflation dynamic is a lot healthier in that part of the world. Moreover, as you mentioned, the corporate governance push is real, continues to happen, and we have the BOJ that has managed to move ever so slightly towards tweaking its policy framework without creating massive disruption. So I think we are, I've seen some evidence that even downplay the risk that you might have been concerned about. And so we think that has more to run into 2024. And the reality is that Japan has done well, but there's room to do better, even when you compare to other markets, US, Europe, on a relative basis, that still has some catch up to play.
How big is the risk, and this is not just pertaining to Japan, when it comes to BOJ expectations, which again are shifting a little bit this week, but certainly Fed pricing, certainly pricing for some of these other central banks to cut this year. Do you think markets have gotten ahead of themselves?
So, yes, I do think, but the reality is we have had a very significant green light from, I think, the Fed in December, where we have Chairman Powell that has basically fully endorse immaculate disinflation, soft lending type of scenario as his base case. And while I don't think this is a done deal, I think there's I think we're going to see something more complicated than that playing out during the course of 2024. The reality is that this is the kind of the scenario that the Fed is going with. That has created the expectation that the Fed will be able to cut rates over the course of the next few months, despite inflation not being back at 2, and that is now the big dynamic, and I think that's going to create support for a risk asset for DM equities that I think, as momentum, can continue for months. That said, and to your point, I think the market has got ahead of themselves itself because we don't think inflation is resolved. It's going to go to 2, towards 2, and closer to at 2 in 2024. But we see eventually inflation coming back up towards 3 as we get closer to 2025. And that's going to be the thing to watch in 2024. As this inflation narrative shifts, then I think market will realize that the aggressive cuts that they're expecting will not materialize. So I think we're going to see 2-3 cuts from the Fed in 2024, not 6 or 8 as the market has been expecting over the last few weeks.
You know, 2023 was a year where we saw global assets really ultimately shrugging off the war in Ukraine, the ongoing war also in Gaza. If a US-China conflict was to add to that picture, do you think global assets would be impacted meaningfully?
Well, you know, we believe that beyond just the macro backdrop that we need to pay attention to, obviously, this environment is very different from what we've experienced for most of the decades prior to 2020. And one of the reasons is we have geopolitics that now is a thematic. It's a mega force that investors need to grapple with. I don't think this is something that leads to necessarily a risk-off environment. I think that's going to be driven more by central bank. And, you know, if there's one lesson from 2023, is that we've seen a lot of volatility, but all driven by central bank, expectations. So I think that continues to be the case for 2024. That said, geopolitics will be a concern at times, might create some additional volatility, but I don't think it creates a different market environment overall.
Are there any contrarian views that you think could shape up this year? Do you have any interest in exposure to Chinese equities?
So in terms of contrarian views, I think, as I mentioned, I think the main one is the market has been running aggressively with the soft landing view. The Fed has been underwriting this for now. But I think we are very much of the view that inflation, while it's going to go to 2, it's going to be complicated because we're going to see all the news for now going in a direction where inflation is getting resolved. I think that's going to create additional momentum on markets and so on. But we already see at play dynamics that will bring inflation back up towards 3. I think the labor market, wages growth, services price is not a story now, but we think it's going to be a story later this year. So that's contrarian compared to the market is expecting. And so that leads us to see opportunities to be nimble now and be bullish, but at the same time the need to be able to pivot. And one of our key theme in 2024 in the investment outlook is grabbing the wheel. The need to be dynamic, active, and you cannot set your portfolio and forget it for the entire year. So that's, I think, is somewhat contrarian compared to the systematic optimism you see. We share the near term, but we think it's going to get a bit more challenging throughout the year. When it comes to China, I think our biggest surprise in 2023 was the restart that we thought would uncover very significant rebound and activity. And what we discovered was, in fact, that there was something missing. And it was the animal spirit for consumers and investors in domestic consumers and domestic investors. And that has been revealed. And I think calls into question, the appetite, the sentiment that the domestic consumers has about the future. And that makes us more cautious now on China. So unfortunately, not a contrarian view here. I think we're very much with the consensus that the outlook is more tricky for China.
Jean-Paul Vonnie, head of the BlackRock Investment Institute. Really great to have you with us. Let's get you back to Belle in Hong Kong, who's taking a look at really how we kind of kicked off the morning, right? This wild ride when it comes to the SEC and Bitcoin.
Yeah, just to say the least. I mean, it's been some pretty crazy statements we've had out. But just to put it in context, if you're waking up this morning and turning on Bloomberg for the first time, so we had the SEC coming out to say that it hadn't yet approved a spot Bitcoin ETF. There was a post that came out in the last couple of hours that was on the regulator's official X account, but that was debunked by the SEC. And so that included some fake comments purporting to be the SEC chair, Gary Gensler, earlier, saying that, yes, they were going to push ahead. So the SEC, to recap, saying that spot Bitcoin ETFs not approved at this point. And so the market reaction, we had a whipsaw coming through in Bitcoin prices. We're now trading up again. But important to note those crypto-linked companies. So yesterday we actually saw them advancing pretty strongly. Today we're under a little bit of pressure, so a pullback coming through. We'll have more on that in a moment, but we can change to another story as well that we're tracking here this morning in the commodity space, because iron ore, the Singapore contract, down for a 5th straight session. You've got fresh data out from China. It's saying that the nation is struggling with its steel-intensive property sector, so that's really still in the doldrums. Industrial metals have been mixed generally, and so you have got that weakness coming through with Aussie miners. They're leading the drop so far for the stocks there.
Annabelle, thank you. Well, up next, Boeing's CEO vows complete transparency after a mid-air blowout renewed questions about the quality of its manufacturing. This is Bloomberg. The U.S. securities regulator says its main social media account was compromised when a post appeared saying it was approving spot Bitcoin ETFs. Annabelle Droulers joins us now with the details from Hong Kong. So, Annabelle, we've heard a little more from the SEC in the intervening hours. Tell us about what we're hearing.
Yeah, that's right. So they put out a statement essentially to give further clarification on exactly what happened with its social media account earlier this morning, or just in the last few hours. So essentially, the statement says that they haven't yet granted approval for spot Bitcoin ETFs. They're saying that there was unauthorized access to the account. There was unauthorized activity as well on it by an unknown party for a brief period of time, and that unauthorized access has been terminated. Now, the SEC also says that it's going to be working with authorities to try and really get to the bottom of what exactly happened in this case. But certainly something that did cause a lot of confusion, really, because earlier today we did have a statement coming out purportedly from the SEC chair, Gary Gensler, saying that they were going to proceed. Again, that's something that Gary Gensler on his personal account said as well, that it was compromised and there was unauthorized access. So it's a very interesting timing, of course, because we really are down to that countdown now for when we do see something possibly being approved.
Belle, does this affect the process for, what I assume does still come next, which is the approval?
Yeah, well, I think out of all of this, what doesn't change is that the SEC is duty-bound to respond to ARK's ETF application, and the deadline for that is January 10. We know that about a dozen companies have applied to list ETFs that are backed by Bitcoin in the US, and the SEC has to actually take action on at least one of those applications by that point in time. The people that we've spoken to in the crypto industry, they say that even with all of this confusion, perhaps it wasn't really on the cards or in the cards for today. It doesn't really change the status quo here. There still is that expectation that we are going to see something being approved. At least that's what analysts are saying. Of course, this has been a process 10 years in the making, and Bitcoin itself throws up a lot of wild cards, a lot of volatility. So you don't want to sort of count your chickens here, but something we're going to be tracking very closely, because that countdown is still on, and we're less than 24 hours now until the SEC has to respond in some form.
Annabelle there in Hong Kong. We're turning to one of our other top stories that we're watching in the corporate space. Boeing CEO Dave Calhoun says the plane maker must own up to its shortcomings as it grapples with the fallout from a mid-air fuselage blowout. Calhoun called for an all-hands meeting on Tuesday. Bloomberg's Katrina Nicholas joins us now in Sydney. What was said during the meeting? And I'm curious about sort of the tone and the direction that the leadership is taking out of this.
Yeah, well, very much something of a mea culpa, I guess you could say, from Boeing this morning, which held this all-hands meeting at a factory 737 Max factory just outside of Seattle. And Boeing CEO Dave Calhoun taking to the stage there, flanked by Stan Deal, who is the commercial airlines chief, and also Mike Delaney, who heads up safety for the plane maker. And both of them really, all of them acknowledging their mistake, saying how serious this incident was, and it's something that should never happen again. Also a big focus on quality assurance. Engineers very much being encouraged to speak up and say something if they see that there are lapses actually taking place in the manufacturing process. Something of a bittersweet moment though for Boeing, because the other news that we had was their December delivery orders, and it was a record. I mean, you know, Boeing said that they had about 301 orders placed for their best-selling MAX 737 jet, and about 370 orders for December all up. So a record month. So this is, you know, this Alaska Airlines incident over the weekend is really detracting from what should have been, you know, quite a time to celebrate at Boeing.
Yeah, also extraordinarily lucky though for Boeing. It could have been so much worse, right, Katrina? And the NTSB has flagged that it may look now to widen its investigation. So what's the latest on that front?
That's right. The NTSB said at the most recent press briefing that they held yesterday that they would perhaps consider widening the investigation if warranted. The focus seems to be around these 4 bolts that haven't been found yet. And these were bolts that were on this door plug and that would have stopped the door from sort of moving up and being ejected out of the plane, which is what caused the cabin depressurization that we saw. Now, these 4 bolts haven't been found by NTSB safety investigators yet. And there's also a question around, you know, were they there in the first place? So that's certainly going to be something the NTSB is going to be looking at very closely. It came after United Airlines and Alaska Airlines said that they had found more loose bolts, and even we had news from you know, one of the carriers in India saying that there was a washer that they didn't find on one of their MAX planes. So this is all obviously very worrying from an engineering perspective.
Bloomberg's Katrina Nicholas here in Sydney. More to come here on Daybreak Asia. This is Bloomberg.
I think we have to recognize just how incapable we, the United States, and our present set of global leaders are in trying to contain the geopolitical risks and conflicts that we face today. The United States has zero ability to actually make those messages land with the actors on the ground who are escalating this conflict.
Eurasia Group President Ian Bremmer on why he thinks the US is incapable of containing geopolitical risks. And staying on that, China upgraded diplomatic ties with a record number of countries last year in a bid to rally support from the global south and counter the US-led order. A Bloomberg analysis showing Beijing elevated the way that it described ties with 17 countries and territories, including Syria, Ethiopia and Venezuela. That is the highest number since President Xi Jinping took power over a decade ago. China's top envoy to the US says Beijing has no room for compromise with those advocating for Taiwan's independence. Ambassador Xie Feng said he's urging the US to follow the One China principle. Taiwan votes for its next president this Saturday. China has previously called Taiwan's ruling party's candidate, Lai Ching-te, a troublemaker whose views risk sparking a conflict. And quite clearly, relations with Beijing are top of mind for voters heading into Saturday's poll. Bloomberg's Stephen Engel reports from a rally for one of the opposition candidates from the traditionally Beijing-friendly KMT party.
It was a homecoming crush for opposition KMT presidential hopeful Ho Yo-i as he rallied the faithful in his hometown of Jiayi in southern Taiwan. Ho and the other opposition candidate, Ke Wen-je of the Taiwan People's Party, or TPP, are making separate last-minute pushes to defeat the more independence-minded ruling DPP and its candidate, Vice President Lai Ching-te. It's a 3-horse race for Saturday's election after the two opposition opposition camps failed to form an alliance, a fraught union that could end up splitting the opposition vote.
I feel like the biggest room for cooperation between KMT and TPP will be the number of seats in the legislature. Our goals are the same, to switch the party in power. The DPP government has not been doing well for the past few years. People are more fearful.
That fear she's referring to was amplified Tuesday afternoon when cell phones island-wide blared emergency alerts erroneously saying that a Chinese missile had flown over Taiwan, and for citizens to be aware. The KMT was quick to latch on to the mistake.
When I first got the alert, I thought it was an earthquake. It turned out to be just a satellite. But the English in the message said it was a missile, so it made people panic. Even though the DPP came out and apologized, it never should have happened, especially now when the election is so intense. It made people feel threatened by China, as if they want to take over Taiwan. I feel like the DPP manufactured this fear.
These two KMT supporters felt the same way and see closer ties with China as a benefit, not a threat.
We need to keep good communication with the Chinese Communist Party so we won't have a war.
The two main opposition candidates agree that the DPP is putting Taiwan at risk and that they must diffuse tension across the Taiwan Strait. Now, on the other hand, they cannot show to the Taiwanese people ahead of this election that they're cozying up to Beijing too closely and that people could perceive that their efforts to get closer to China could put the long, hard-fought democracy and freedom here in Taiwan in jeopardy.
I think being closer with China for trade is not such a bad thing. But freedom of thought is what I want more. So I don't want to be closer with China.
It may be the very issue that decides the vote and sets the broader geopolitical tone in East Asia.
It's very, very important, this election, because it's life or death for the Republic of China. Because China is our roots. China and us are inseparable.
Stephen Engel, Bloomberg News, Jiayi, Taiwan.
And we'll have special coverage from Taiwan all week in the lead up to the vote. And the full results and analysis, of course, from Monday. Taking a look at where we stand now, equities-wise, across Asia. One of the only markets higher right now, Japan. The Nikkei 225 up almost 1%, climbing after we got base pay growth, which was at 1990s levels. So the base pay for regular workers rose 1.9% from a year earlier, according to the earlier reading. That's the reading on the BOJ's preferred measure of wage growth. So it strips out the distortions from sample changes. Now, elsewhere across Asia, not so lucky. The Kospi down 0.2%. Australia and New Zealand also lower on their benchmarks. And we do have the yen trading right now at 144.57. Just fractionally weaker. Plenty more to come right here on Daybreak Asia. This is Bloomberg.
We do have a key inflation number just crossing the Bloomberg now for Australia. We are really just seeing CPI on a month-on-month basis, year-on-year, I should say, for November, coming in at 4.3%, a little bit softer than expectations of 4.4%, and also falling from that 4.9% in the previous reading. So again, we were expecting that pullback, given a pullback in fuel prices was part of that equation, expected to slow that inflation read in November. Bloomberg Economics seeing year-on-year inflation coming in at 4.4% in the actual read, just a little bit softer than that. There are sort of expectations that the RBA will probably wait for some of the December numbers, fourth quarter numbers, before making kind of real decisions about whether this forms part of a sustainable downtrend. But certainly that shows a dynamic of perhaps a little bit less pressure on inflationary pressures. But still, some of these concerns over housing costs, insurance, utilities, likely to make it a bit of a coin toss in terms of what we see next from the RBA, Belle.
Yeah, they're probably likely as well to just wait until we get the December numbers, since that's the November reading you just spoke about, and also the quarterly figures in tandem. But the setup that we're seeing so far in the Asian session, we've got Aussie stocks treading water really at this point in time. We haven't really seen too much reaction either coming through in bond yields. But the key market really to track here is what we're seeing in Japan, because that's the highest level that we've seen for the Nikkei since 1990. So really Japanese stocks, the big question is whether they continue to see those gains over the course of this year. Quite a few analysts that we've spoken to are pretty optimistic on the odds of that happening. And one of the factors is the BOJ still expected to stay dovish. And then also you've got corporate governance reform. So that's what we're watching so far in the session. Aside from Japan, the other thing that's really standing out on the board is the moves that we're seeing for iron ore here. Let's pull up and take a look at iron ore over a 5-day period, because actually we're tracking here for a 5-day slide. Price is back down to 135. You're off around 5% over the past few sessions. Industrial metals in China, they're fairly mixed, but also is still seeing further weakness coming through for the property sector. Iron ore, of course, a key ingredient for the real estate sector. So that is likewise playing into what's the biggest drag so far for Asian stocks through the session. Let's take a look at some of the big movers here in the materials space, and a lot of those are coming through from Aussie miners. You can see that drop here, for instance, mineral resources down around 5%, Heidi, at this point in time.
Well, Belle, over the next few weeks, the governments from the US, UK, Eurozone and Japan will start flooding the market with bonds at a pace rarely seen before. Bloomberg Intelligence estimating they'll offer $2.1 trillion of new bonds to finance their 2024 spending plans. For more, let's bring our chief rates correspondent for Asia and MLive contributor Garfield Reynolds. So does this run the risk of a reality check, I guess, for some of these recent rallies that have been sustained?
Yeah, Heidi, I think it's definitely something that the bond market started looking past when sort of rate cut fever struck late last year. But as we saw in the first week of this year, when some supply concerns were part of the reason for the pullback, a bit of a backup in yields, it remains one of the key dangers that could either mean bonds don't do nearly as well this year as expected, or even that we see some losses. And if you look at what went on last year we came in to 2023 expecting massive bond rallies because the Fed was just about done with cutting rates, and so that burden was going to be removed. This year we've got the same sort of setup. There's less of a risk, you would think, of the Fed acting as a major pain point. I mean, if the Fed hurts the bond market, it will be because it doesn't cut as fast. So the question is, well, what are the risks that would actually deliver losses for bonds? And this is a key part of it. If investors start to decide that the amount of bonds that governments are selling to them are more than they want to absorb, then the only way, and the governments don't really have much of a choice in this, they're going to need to sell these bonds. They're relying on investors to buy them. So if investors become more reluctant than they have been recently, that's going to drive up yields. And as we saw in sort of the September-October period last year, if that becomes a concern, that can lead to some very rapid repricing in where bonds are.
Yeah, Garfield, I mean, if the supply side does end up mattering this year, what would be the drivers for that, do you think?
Well, I'd sort of flicked at one of the drivers, which would be the potential that central banks might not be as rapid in cutting rates as expected. But the real key is partly central banks, and it's partly where central banks have brought us to. So on the first side, a lot of central banks bought an enormous amount of government bonds over recent years. Apart from the Bank of Japan, they've all stopped doing that, and they've started moving, or have moved, to reduce the bonds they buy. So that's part of why this is such a danger, is because not only are you getting more bonds coming online, you're getting more of a burden placed on the private sector because central banks aren't doing so much buying. The other side of things is a little bit more counterintuitive in that central banks are slowing the global economy. Normally, a slower global economy is good for bonds because it, lower growth means lower yields and so on. But it can also mean that the supply part of the equation becomes more dangerous, because that's also a spur. Governments have been planning to sell lots of bonds even with growth doing well. When growth does poorly, it's much, much harder for them to restrain those bond sales. So you get the potential that we've got 2.1 trillion expected this year. It could be much higher, the supply coming, if the global economy worsens.
It's all going to be about incentives, right, Garfield? That is Bloomberg's chief rates correspondent for Asia and MLive contributor Garfield Reynolds there. Well, tying this all in with currencies now, and our next guest is Long, the yen. Christopher Wong, FX strategist at OCBC, joins us now. So, Chris, I'm just curious what you make of all of this data. So, on the one hand, we had data out of Tokyo that showed consumer price gains slowing, so inflation slowing. And on the other hand, we saw just an hour ago that data that showed, wages are increasing sort of without the base effect at the fastest rate since the 1990s. What kind of shape is Japan's economy in?
Yes. Basically, I think if you look at the grand scheme of things, inflationary pressures in Japan are pretty much broadening. Although the headline actually rose slower, but the services CPI in Japan is pretty much still rising at its fastest pace since 1993. Growth and sentiment outlooks is improving, and the upward pressure on the wage growth is still intact. And I think the upcoming Shunto wage negotiation, we should continue to see further upward adjustments in wages. So what it means here is that it's going to lead to a potential removal of the NIRP, or negative interest rate policy regime, and for the BOJ to step away from the yield curve control. We think it's more likely to be sooner rather than later, before the middle of the year. And once it's going to happen for dollar yen, this is going to be a bit of a policy divergence between, a BOJ that's potentially moving, and then with a Fed that's potentially cutting rates. So that should support dollar yen to the downside.
So I think the consensus is that it would happen around April. That seems to be what you're suggesting as well. So what kind of level are you targeting on the yen, when that does happen?
Yeah, given where it is now, I think somewhere towards the 138, 135, towards that level, by the middle of this year, is pretty much likely.
138 to 135. Wow, that would be a stunning move. And so what does that do then to the dollar and to the differential, Chris? Because obviously then at that point, the Federal Reserve may already have gone, or it may be going the following month in May, or maybe not either of those scenarios.
Yeah, so basically, I think if we look at US in general, if we look at the labor markets data, although the headline NFP has surprised to the upside, but pretty much if we look at quit rates, job openings, downward revisions to NFP, they are all on the downtrend. And if you look at the labor force participation, there is also a fall in that, and sharp decline in ISM services employment. So all of this suggests that the tightness in the US labor market is actually starting to show up. And whether the disinflation trend is going to be more entrenched, I think that's something that we are paying close attention to. I think all of this suggests that Fed is done, and likely our house view is we believe that 2Q could be as early as 2Q, where the Fed will undertake a rate cut. And on that note, that should continue to play out in terms of the narrowing yield differentials between the US and Japan.
How concerned are you, though, that the market might be becoming a little bit complacent? The phrase reverse Goldilocks scenario has been going around today, in the sense that, perhaps inflation is stickier and it may even rise again.
I think it's important to note that this dollar decline is not a one-way trade. Expectations for Fed to ease can result in dollar overshooting in the short term to the downside. And when these expectations get par, which is now, you tend to see that dollar upward adjustments it's happening with the dollar short squeeze in the markets. So I think it's important to know that this is not a one-way trade. Expectations do has its ebbs and flows, and the bias to sell rally is something that we kind of are more leaning towards in terms of looking at the dollar.
I do want to ask you about the euro as well, because fresh iterations today that the ECB will for sure cut sometime this year, but there is a wide divergence of views. Mario Centeno saying it could be the first half, and then Governor Villeroy saying we don't know when it's going to be. Somebody else said, you know, it's probably not going to be till later in the year. When does the euro area hit recession? When does the ECB cut?
Yeah, our view on ECB and the euro itself is it's going to be a case where they will potentially move rates this year, but it's likely to be a case of a later time frame as compared to the dollar or the Fed. On that note, if you look at some of the CPI data coming out of Europe and some of the PMIs coming out of Europe, although the PMI out of Europe is still in contractionary territory, but there is some signs that there could be a slight improvement on that note. So I think they do have some tendency or some room to keep rates where they are for the time being, and that divergence between the ECB and the Fed, temporary divergence, should continue to keep the euro temporarily supported in the interim. But what I'll be concerned of is the elections calendar in Europe. It's going to be a very heavy calendar, and I think that's something that we should keep a close lookout for.
Chris, thank you so much for your time today. That's Christopher Wong, FX strategist at OCBC. Plenty more to come. Stay with us on Daybreak Asia. This is Bloomberg. Intelligence tracks around 2,000 companies over a wide range of sectors. And this year, its analysts have identified 50 firms around the world that warrant a closer look. Among those are companies that are highly exposed to China's troubled property market. Bloomberg Intelligence analysts Francis Chan and Patrick Wong join us now. Thanks to both of you for joining us. So, Patrick, talk to us a little bit about some of the property firms that may be adversely impacted by China's crash.
Yes, so for China, I think the property market is still challenging in 2024, and especially for the first half. We see the property sales could drop another 20% year over year, and for major developers. And I think this is also have an impact on not just the developers and also the property service company. So say, for example, our pick like A-Living is the company with the parent company Agile. I think the challenge for them is for those developers focusing on like lower tier cities, tier 2, tier 3 cities will be very challenging, and the sales may drop even more. For tier 1 cities may be a little bit better, but having said that, I think for developers like Agile or even some others, those A-Living, those public service company, the pipeline will be weakened with the sales coming down. So end up for those property management companies, they will have a big impact in terms of the revenue driver over the next couple of years.
Patrick, what are you expecting when it comes to policy support and how it could or could not meaningfully change the outlook?
Yes, I think for the overall market, the property easing, of course, we see over the past couple of months, like mainland China, we have a couple of easing, and then even for Hong Kong, we also see the easing happening, mortgage easing, for example. But having said that, the property sales, we didn't see much impact for now, right? We would like to see more and more support from the government, and in terms of the overall monetary easing or even some more policy measures to support the overall market. But this may take some time to resolve. And we also look at Hong Kong, and then for Hong Kong, we also see, like, for example, my pick, like Sun Hung Kai is another one that we would see the sales may not be recovered really fast. And it take a little bit time, like even the U.S. Federal Reserve will cut rates at later this year or even in March. But for Hong Kong, it takes some time to reflect the mortgage rate cut in terms of to support the home sales in Hong Kong. So for Hong Kong developers, still a bit challenging, especially for the first half for the home sales.
Francis, what do you see as the potential exposure to China's banks?
Yeah. Obviously, along similar lines with what Patrick has mentioned, the lingering property downturn in China will spill over or has already spilling over to the banking sector, its asset quality. We're expecting that to deteriorate through 2024. We haven't seen a lot of deterioration in the set of figures in the first 9 months of last year, but we'll definitely see more, defaults from the property developing sector. And also another area of a crisis could be the local government financing vehicles, which has been talked about by IMF or many economists in the world for years. And now we have more of that crisis unfold this year. ICBC, which is the largest bank by the total assets in China and probably in the world, could be the focus. We may look forward to worsening the loan quality for the bank, and hence it may need to charge off more for its bad loans from those sectors, hurting its earnings in 2024.
It's a pretty dire outlook. In fact, Francis, ICBC and 10 other banks that you track, you say they could struggle for any kind of revenue growth.
Yep.
What kind of systemic risk would this be to the system? I'm talking about the non-banking system and beyond in China.
Yeah, the top two systemic issues for Chinese banking sector financial system would be the property downturn and local government's financing the condition. Following that could be the the shadow banking industry. Very recently, we have Zhongji Enterprise, which filed its bankruptcy just last week, and it may also have some spillover impact to other parts of the financial system, including the banks I cover.
Bloomberg intelligence analyst Francis Chan and Patrick Wong there. Of course, two key sectors to watch for China in 2024, property and banks. Plenty more to come here on Daybreak Asia. This is Bloomberg. Well, AI is unsurprisingly taking center stage at CES in Las Vegas. ARM CEO Rene Haas spoke to us about the opportunities and trends that the chip designer is seeing in that space.
If you think about all these devices becoming smart devices, whether it's a smart Roomba, smart washer and dryer, smart TV, they all need a brain inside that helps them learn what to do. That brain inside is ARM. So we were just chatting earlier about, well, where is ARM inside the show floor? Those four examples I just gave you, a washer, a dryer, digital television, and a Roomba, I can assure you each one of those devices, ARM is the brain that makes those go.
The common connection between everything here is AI. Whether you're an automotive company, consumer electronics, even a beauty and healthcare company, ARM wants to be a part of the AI story. So let's start with that. The story of 2023 was the H100, a GPU that goes into a server design. The server design goes into a data center. ARM's not quite fully in that market yet, but it wants to be. So give us a scorecard and where your progress has been.
I think you have to step back and say, well, what is AI and where is AI going? AI has been with us today already to some level. For example, Amazon Alexa, Google Assistant, Ring camera, Nest camera, things that do facial recognition, for example, in those cameras, that's AI, and that's running on ARM today. So to some level, we've already been there. Now, what's happened with ChatGPT and these large language models has been this next level step up of really a level of learning and AI we've not seen before. So a lot of that work today is taking place in the cloud with training, and you mentioned H100. NVIDIA's next generation device, the GH200, is Grace Hopper. Grace is the CPU, all ARM-based. Hopper is the GPU. So even in the most advanced training workloads, you're seeing ARM being used.
on device. Cristiano Amon of Qualcomm was here earlier in that seat wanting to talk about on device. What benefit does ARM feel from a consumer that's willing to buy a smartphone in particular where they can locally run a large language model or a generative AI tool powered by it?
I think it's still early days in terms of what are the applications that are going to be really killer for the smartphones. The hardware is enabled now, so you have capability now inside the smartphone that can run these AI algorithms. But for example, two areas that people really care about are latency and privacy. So if you're running some ChatGPT or a personal assistant such as Pi by a company called Inflection AI, every query that you enter on your smartphone goes up into the cloud. So people who care a lot about security of their data are going to want to have those AI algorithms running locally, and not the least of which they'll run faster because they're running inside your hand.
We're trying to assess what the smartphone market is going to look like in 2024. It's still the mainstay of your business. But it goes to a sort of functionality level. What do you think it is that we can put into a smartphone or enable a smartphone to do that drives an upgrade cycle and brings consumer enthusiasm?
I think one thing that we've seen in this last cycle, which I think hopefully we're on the bottom of, and now we're starting to come out of it, is that the premium smartphones, the most expensive smartphones, have actually done very, very well. And that's because people are trying to future-proof technology and their purchases to make sure they last a long time before the upgrade. As I said, it's still early days on what are these devices really going to do in terms of running the applications, but I think security and I think latency and power efficiency when you're running those algorithms are very key. Those are three areas that ARM is really good at.
And that's ARM CEO Rene Haas there with Bloomberg technology anchor Ed Ludlow. Also at CES, Honda has appeared to walk back a plan to deploy a self-driving car developed with GM by early 2026. CEO Toshihiro Mibe told Bloomberg he now expects driverless vehicles to debut by the end of the decade. Honda announced a joint venture back in October with GM's autonomous vehicle unit, Cruise.
We're thinking of sometime in the late 2020s for introducing self-driving vehicles into an urban environment. The car we're introducing for 2026 will not have such advanced technology.
And that was the Honda CEO with our Bloomberg Daybreak co-anchor Sherry An. That is it from Daybreak Asia. Our markets coverage continues as we look ahead to the start of trade in Hong Kong, Shanghai and Shenzhen. Stand by for Bloomberg Markets China Open. This is Bloomberg.